Good morning. Thank you for listening in here to hear about our new company. METALLA Royalty and Streaming, we're a royalty and streaming company. As Eric mentioned, I'm Brett Heath, the CEO. And for those of you that are not familiar with the royalty and streaming model, what we do is we own non-dilutive interests. Now that's one of the most important parts that I can tell you, non-dilutive interests in mining operations. And these interests are in the form of royalties and streams. And very simply put, royalty, if you own a 1% royalty on a project or a 2% royalty on your project, you or our company gets 1 to 2% of what's mined or what's ever mined on that project for life. And that's important because when you look at really the life cycle of these companies, what are you faced with? I mean, when you're investing in precious metals, obviously you have physical, but a lot of people are probably here today because they're more interested in maybe some leverage, something that will probably outperform precious metals if they rise, or actually be a real business. And when you look at what you're typically faced with here, from the majors all the way down to the exploration companies, you're faced with really just a lot of bad choices. Exploration, has returned phenomenal returns on if you can pick that, very, very small, really one or less than one out of 100 companies that make a material deposit, over 1 million ounces of gold that actually goes into production. But it's just really bad odds as an investor to be looking at companies to find these things at these levels, and those are just the numbers. The problem here is that once they discover something, then what do? They drill, they dilute, they raise money for working capital, they raise money for expensive studies, and if they can prove that the deposit is economic, then they have to raise a bunch more money or put on a bunch more debt to build the thing. By the time it goes through this whole process to production or a large company, your 1% may be just completely insignificant in regards to how much of that asset you actually have exposure to as an investor. Now, if we have a royalty and a discovery is made, we could see $500 million, $1 billion of CapEx spent, and we still have our 1% by the time it's producing at full capacity. So that's really the benefit of owning a royalty and streaming company. And that's why these types of companies are, historically have been really the true growth companies in this industry. And you can look at the larger side of the space, the mid-tier majors, and unfortunately, they have a history of not timing the market as well, and basically having capital destruction on the other side. In 2015, we had about 53 billion of impairments. 53 billion. That's almost wiping out the whole TSX venture. 1 year. Not too good there. A lot of capital destruction. So, what do you guys do? The answer of a lot of smart money that's been in the space for a long time is hide out in these royalty and streaming companies. On the precious metal side, there's only about 10. Most of them are over $1 billion market cap, and there's a reason, because the model actually works. Part of it is the diversification, not only the non-dilutive part, but the diversification approach and the scalability of these companies is really just incredible. We'll go into that a little bit later, but just from what you've seen here, during the downturn, the market was off by a lot of the companies on the junior side, over 90%, where Franco-Nevada, some of the bigger royalty and streaming companies were actually bouncing off all-time highs. And the reason why that happened is even in down markets, these companies can grow. They actually can take advantage of down markets because companies need capital. And you can see the exposure the average large royalty company, you have exposure to 34 producing assets compared to the average major of 9. Now, if you take that back further, I mean, if you're looking at a junior, you may only have exposure to 1. If anything bad happens in that jurisdiction or that, I mean, there's just a ton of risk there that, that you have to evaluate as an investor. So when I started this company 18 months ago, I went to a lot of really smart people in this industry, and a lot of them told me, look, you're too late. You're not going to be able to compete with these big guys. Your cost of capital is going to be too high. It's just not going to work. And what we did is we carved out a strategy, and I think all of these companies need to be a bit different in kind of how they approach the space. And ours stemmed from really the success off these bigger companies. What we saw in the last downturn in the precious metal space, at least, 2012 to early 2016, the streaming and royalty companies really stepped in and filled the gap of the senior lenders. The senior lenders, for the most part, vanished after 08, 09. They got so hurt. A lot of those bigger banks are just like, look, we don't even want to deal with these books. Liquidate them. And the senior lenders came in and actually put more capital to work over that time period than the entire precious metal TSX venture as a group raised in equity. And because of that, their portfolios grew. Their portfolios just grew significantly, and their deals went from 50 million to 100 million to 500 million to $1 billion plus. And what that did was that allowed, from a macro perspective, it made the higher end deals become much more competitive, and actually the returns came down because there's less and less of these larger assets on the planet. But the smaller deals, the deals that really made these companies the billion-dollar companies they are today, the returns actually went up. And so we're here to capitalize now. Now, the second part of that is, being in this business for a while, I've written a number of streams on junior mining companies. And, in my opinion, with my experience, it ended up being much more of a babysitting event than anything else. What I found is that a lot of the junior mining companies, unfortunately, they don't have the skill sets, they don't have the balance sheets, they don't really have what it needs to create a successful mining operation. You've got this geologist that kind of, makes a discovery and then tries to kind of bootstrap his way into production, and you end up with these kind of quasi-junior mining disasters. So we needed to find a way to get into some larger assets. That was really important. Larger assets, larger counterparties. This is what drives the premium for the streaming and royalty companies. Now, as a small company, that's a really difficult thing to do, because we can't go to a Glencore or a Barrick and say, here's $5 or $10 or $15 million, because they just won't take it. So part of the strategy was focusing on third-party acquisitions. And these are existing royalties and streams, that were written kind of when the property was discovered and then optioned to a junior and then taken over by a major, but this royalty is still here. And so since we started, 18 months, we've done 6 transactions. We've done transactions with private individuals, private equity funds, private companies, major mining companies. Common denominator for all of this, all of these groups were not getting the true value for these assets they were holding. And the reason is because they're not really worth what they are in the market unless they're held in a clean and focused vehicle. So when we did these transactions, there was an immediate value or revaluation of these assets when you take them from a private company or at the bottom of a major company and put them into a very clean and focused vehicle with a tight cost structure and a good management team. There's a huge value arb there. And that's why every single deal that we've done, those groups mostly took shares as consideration, have made money. So that's a real interesting model. And now I would say it's proven, and we've been able to do a great job to continue to scale this out. And as you can see here, it's added a lot of value. We were one of the best performing companies in 2016 and 2017. We were only outperformed by Arico, which was a peer that got taken out for about 300 million. And I think we'll outperform this year as well. Diversified portfolio, this is important. Again, as I said, certain things that drive premiums, this is what we're after, and this is what drives, and I think you'll continue to see more of this as we grow. We've got 3 producing assets. The most of our production comes from a silver stream off one of the largest lead zinc silver mines in Australia. Been in production since 1983. We think it's going to be a cornerstone asset for us for quite some time. We've got another silver stream on an 80 to 90,000 ounce gold producer and a royalty on a 2.5 million ounce gold asset down in Ecuador. We've got 3 development assets. First one for us to go into production is going to be the Joaquin royalty, which is a development asset from Pan American Silver, one of the best operators in the world. And they just allocated about a little over $40 million to build this mine. And it was only one high-grade section that they basically took 11 million ounces of the 65 and brought it into reserve. This is going to go into production or start cash flowing us probably in late 2019 and bring us an additional, $1.5 to $2 million a year. Again, we didn't have to write any checks for that. We acquired this asset last year. It'll be in production in another year and a half or so from now, and we've got a great operator. And these are the types of assets that we want. And these are the types, by focusing on our strategy and doing the types of transactions, especially on the third-party stuff, this is what we're able to get. We've got a royalty on the extension property of the Hoyle Pond Mine. This is basically the entire engine of the Porcupine Camp in Timmins. And also on an extension royalty on the Timmins West Mine up in, the same camp up in Timmins, that's Tahoe Resources. Exploration portfolio. This isn't something that we're really focused on, but when we come across a package of these assets, specifically in a good gold camp, beginning of this presentation, I said, look, the odds are less than 1%. If we can get 100 of these in a good camp, our odds go way up. Some of the best investments on the royalty and streaming side were through these smaller exploration type of deals. You had Detour Gold with Franco and Gold Strike. Gold Strike was a $2 million investment by Franco back in the 80s, and it's returned over $1 billion in cash. So we think owning a big portfolio of these in good mining areas with lots of big mines already around them are a good thing. We've built our company up here. We just added 2 new board members. First one being Frank Hannegarn. He's 17 years. Newmont actually managed the Franco portfolio within Newmont as Newmont Capital and was the gentleman that really led the process to re-IPO it for $1.3 billion. He's currently the COO of Core Mining, which operates over a number of mining assets. So a ton of operational experience. And Alexander Molyneux, 10 plus years of head of investment banking for UBS and Citigroup out of Asia. And currently he's an executive and a director of a number of companies, but incredible network, and we're really looking forward to take advantage of that. Lawrence Ralston, E.B. Tucker, also on our board. They've been on our board for a while. Lawrence, tremendously helpful on the technical side, and E.B. on the marketing. And we've got the ex-corp dev of Premier Royalty that we just brought on. That was the corporate development officer for Premier Royalties, which was a couple years ago taken over by Sandstorm for a little under 100 million. So great team, but just real quick to touch on the team. This is all we need to scale our company to probably a 500 million market cap. These companies have some of the highest revenue to employee metrics of almost any industry. It's really incredible. Franco, Royal, the top 3 companies average between 18 and 24 million in revenue per employee. Newmont Mining's about 200 to 300,000. Goldman Sachs is about 300,000. Google's about 100,000. These are just incredible revenue to employee metrics, you've got these really small teams generating enormous amounts of productivity, and the reason is because, you know, we can scale this business. You know, 18 months 18 months in business, we've got 18 assets. If we stopped the company today, our shareholders would be receiving dividends for probably the next 20 years. And that's pretty incredible. And that drives me into our dividends. We're one of the smallest companies. The TSX Venture actually didn't know the logistics when we asked them, when we told them we wanted to pay a dividend. They had to go ask the TSX. Because none of these companies ever return capital. They just don't. And I think that's been forgotten. And we want to stand out, and that's why we're doing that. Some of our early investors will have almost a 10% yield when we raise this in June at their cost basis. It'll be about a 2.6% if you can get you know, a cost basis at today's price. But look, I think a year from now, if you have a cost basis at today's price, it's probably going to be something in the high single digits at least. We're going to continue to grow this. And as a new company, you know, 18 months in business, we'll pay out more in dividends this year than our entire G&A. You know, what's the question that is the first thing that you guys ask to a lot of these companies? What's your burn rate? Like, you're so worried that they're going to run out of money before they can drill or, you know, figure out whatever they need to do. Well, you know, we can give you exposure to production, to development, to exploration, yet we have cash flow. We can pay a dividend and still add to our treasury every month. So why invest now? Why is it an opportunity? I think it's an incredible opportunity right now, and mainly because of the valuation. Most of these companies were formed via spin out of a major. Now, what did that do? That gave these companies a high premium right out of the gate. Mavericks Metals had a $100 million market cap day one when it was spun out of Pan American Silver because it's Ross Beatty's company. We built this from the ground up, so we have to do a little bit more work to prove ourselves and get the valuations of these bigger companies. Now, that gives an opportunity for you guys to make some money, and that's, you know, I imagine why you're here today. We're doing about half next year, our projected next year operating cash flow. So we'll do about $6 million this year, 8 million Canadian next year, and probably through 10 the year after with just our existing assets. And historically, when you see this multiple expand on how these companies are valued, it happens when these companies kind of get through that $10 million mark. Coincidentally, that's also when the majors start to look at you. And we did just see that with Orico taken out, I think, 15 to 20 times. We're trading probably about 5 to 6 times next year's operating cash flow. And we can use this model that we've carved out and I think grow our operating cash flow through 20 million over the next couple of years. So you can just look and see what that does here. But that's if silver and gold are flat, right? This is a real business. It can thrive at today's prices. One quick thing to remember and end on is that these deals have an incredible amount of leverage. If silver, and by the way, if you're interested in silver, we're actually the purest way to place silver pretty much on the entire TSX Venture or TSX. We're 100% leveraged to silver. We do have a few gold development assets, but even the purest silver producers have a lot of lead and zinc. And you know, we're positioned for that. And the silver to gold ratio has only been over 80 4 times in the last 30 years. Every single time that it's been over 80 for, you know, a small period of time, we've seen some of the biggest moves in precious metals, but specifically to silver. So I think this is an incredible time to position yourself, especially in a company like ours that has a, you know, very, very core strategy of growing the company, and more importantly, being able to carve accretive deals and return real value back to you guys right away, not 10 years down the road. So thank you very much. I will be at my booth if anyone has any questions in the next room.